Okay, good. So tonight we'll talk about chart patterns and formations. Chart patterns is one of the most used in technical analysis, or most used techniques in technical analysis. Even you are going to use it a lot as you'll be trading. So it's best if you can be familiar with it, master it, so you can know how to go about it. Okay. Why are chart patterns important? One, they assist you in identifying ongoing trends, potential reversals, guide your entry and exit points effectively. Patterns, there's someone in the waiting room. Yeah. Let me see if I can. Disable the waiting room. Patterns indicates supports and resistance levels, allowing you to set stop loss order more strategically. They help a lot with that. You can use chart patterns as confirmation for other technical indicators that enhance the reliability of your trading signal. So most of the time when we'll be generating trading signals, we are going to use chart patterns a lot. Okay. Then we have recognizing chart patterns. It helps you to make quicker decisions, saving time and increasing your trading efficiency. It mostly when we use chart patterns, we don't waste time. Is someone struggling to join? Why? Okay. So chart patterns reflects the collective behavior and sentiments of traders, helping you predict future price movements. So let us look at the most commonly traded chart patterns. These are the most used chart patterns that you're going to use. We have what is called double top and double bottom. Double tops and double bottoms. Yesterday we talked about supports and resistance. Okay. Double tops and double bottom, it's basically whereby the market was going up, and then it creates a resistance, then it goes down, and then it creates another top, which is another resistance. And then if this happens, and then the market happens to go down and come and break this, what you have here, this is a support, okay? But in this case, it's known as a neckline. Now what is happening here is when the market goes up, it creates a resistance. As it comes down or it retraces, it creates a support. Now, when it's going to go up, this support that it created here, it's known as a neckline. Okay? Then, if the market happens to come and pass this support that it created here, that is known as a break of a neckline. Okay? Then, if it happens to come down and then it closes with a complete candle, okay, if a candle closes below that, then you can take your sell position, okay, expecting the price to drop. The same as the double bottom, where you have the market was going down and then it creates support in that area. After creating a support in that area, it moves a bit up, creating a resistance. This resistance will now become our neckline. As price gets to drop until here, if it creates another support here, if it comes to break the neckline, this is the neckline, you're gonna take your entry here by expecting the price to continue to go up. That is double bottom and double top. So these are basically the rules that you're gonna use when you're trading supports and resistance, double tops and double bottoms and so on. So the first you are gonna, this one usually occurs, that is a double top, occurs in an uptrend, assuming the price was going up, okay? The market creates two peaks. These two peaks are known as the tops. After a strong movement up, later it forms an M structure. This one, it's also more like an M structure. Some books, you find them as W patterns and M patterns. They are the same. This is a strong sign that a reversal is going to occur. That is, the market will reverse and will start to trend down. Occurs during a downtrend. This one occurs, no, we are not done. Then now what we're gonna happen is when you're gonna enter here, you can now set your stop loss around this area. Sell after price level breaks below the neckline. We spoke about that. Then this one, it's the double bottom. This is the first, not first top. This should supposed to be first bottom. This is second bottom, not top. This was a typo error. It occurs during a downtrend, assuming the market was going down. The market forms two bottoms after a strong downward movement, later W structure. This is a strong sign that a reversal is going to occur. So wait for price to break the neckline level here. Then you're gonna buy, setting your stop loss here, and then your target profit should be somewhere there with a 1 to 2 risk to reward ratio, at least 1 to 2 risk to reward ratio. Okay. Do you have questions on that before we can proceed? We are fine.
Fine.
Okay, good. Let's proceed.
We can continue.
Okay, perfect. Okay. Let's please mute our mics. Netu, please do not unmute your mic. Okay, moving forward, we have what is known as the head and shoulder patterns. This one, it occurs, either in an uptrend or downtrend. So the first one occurs, or it's formed by a peak, okay? This peak, it's known as the shoulder. This is the first shoulder, assuming the market was going up, and then it creates the first shoulder. Then from there, it retraces, creating the first neckline, okay? A neckline is drawn by connecting the lowest points of two upward. This is the strongest sign that the downward, it's more like the same. And then from here, it pushes up again, passing this previous level, that is the previous high. Then until somewhere there, it creates another resistance area, and then it retraces all the way up to where the first neckline was, and then it creates another support, and then it pushes somewhere there, creating another resistance. Now we have three resistance. These two, they are at the same level. This one, it's in the middle. It's a bit up. Now, these two, this is the first shoulder. This is the second shoulder. If the market happens to come and pass here, meaning it passes the neckline, then you take your sell position. You pull the trigger, setting the stop loss on top of the first of the second shoulder. Then you have your target there of 1 to 2 risk to reward ratio. This is more like a structure of a human being. This is like your head. This is like your left shoulder. This is like your right shoulder. So the opposite holds for a head and shoulder pattern. This is when the market was going down, for example, and then it creates your first shoulder, that is a support, and then it retraces this, forming a neckline, and then it continues to go down again, creating a head. Then it retraces at the same level as this neckline, creating a neckline. Then it pushes here, creating your second shoulder. If the market comes and passes the neckline, then you pull your trigger right there. You enter there, setting your stop loss here and your target there. This is just theory, but as we progress, we're gonna look for these patterns on the charts, real charts. So then we have this one, the wage patterns. That is the rising wage and falling wage. These ones, you can simply refer to them as a category of triangles and rectangles. Okay, so you can basically just categorize them as triangles and rectangles, just in summary. So what we have here, we have what is known as the rising wage. Okay, assuming the market was coming from here, it was trending up. Okay, a wage chart pattern occurs when two trend lines are converging. Okay, then from there, what's gonna happen is you are gonna have a market that is forming like a triangle, but that triangle is somehow converging somewhere there at the top. It will retrace, and then it will make a high, and then it will retrace, make a new low, and then it will push a bit high, and then you can simply converge. You can simply see that these ones, they are converging in the corner somewhere there, or the triangle is getting smaller, smaller, and smaller. In this expectation, this is a reversal pattern. The market, we are expecting the market, if the market happens to break this is a trend line. Okay, then we have another trend line. If the market happens to break this area, then we can expect it to push all the way down. Then you're gonna take your sell position somewhere there. Okay, now what we have, a rising wage. It's basically a bearish chart pattern. A bearish, yesterday we said bearish is when you want the market to go down. Basically, when this occurs, then we know that the market is about to go down. It recently occurred today on USD Swiss franc, if I'm not mistaken, and I think it's CAD Swiss franc and USD Swiss franc. This is not exactly, but I was hesitating to give this signal, but that was going to be a sniper entry. But if you check here, this pattern that we are referring, not exactly, but these are the patterns we are referring to. Can you see that the market was going up, and then here it created this trend line, and then we can put a trend line here on top again, somewhere there. Do you see it? Now what we are expecting is if the market happens to break below here, this, then we can expect it to retrace up to there. Then we're gonna take a sell position. So if you see, there are things that we're gonna cover in day 11, order blocks, breaker blocks, gaps. So now we are expecting the market to break and then retrace up to here. Then we're gonna sell in this area setting our stop loss there. Our take profit will be 1 to 2. I'm going to teach you how to use TradingView, whereby it shows you the risk to reward ratio. It automatically calculates the risk to reward ratio. If we pull the trigger there, then meaning if we have to set our stop loss right there, our take profit right here, that will be a risk to reward ratio of a 1. If we want a 1 to 2 risk to reward ratio, we pull, that would be a risk to reward ratio of a 1 to 2. So best we target a risk to reward ratio of 1 to 2 or more. But basically, hope you have an idea on what are patterns, how to use patterns, and what are they. I will I'll show you again more patterns. Just hold a bit. Okay. Now we have a falling wedge. A falling wedge is a bullish chart pattern. The trend lines whereby we are expecting to buy, if we see this, then we look for buying opportunities. That is what we mean by a bullish chart pattern. The trend lines are in a downward slope movement. The resistance trend line is steeper than that of the support. So, but basically what we have here is the market was going down, and then eventually it starts to create something that looks like a triangle, and this triangle is converging at the bottom. It's getting smaller and smaller, creating a corner. Then if the market happens to break this area, then we start to look for buying opportunities, expecting the market to push up. Then we have this one. In an uptrend, this is what I was explaining. This is a rising wedge, and then we have in a downtrend. It can also happen that the market can converge to this corner. If it happens to break somewhere here, okay, then we start to look for selling opportunity, setting our stop loss above there, like I just showed you there. And then we have our target somewhere here, but that is how to use the patterns. And then we have, this is a good example of the patterns. It doesn't really matter. For you, just know them as triangles and rectangles. The wedge, flag, peanut pattern, what. Those, they might confuse you, but just take them as they are right now. Then we have in a downtrend, if the falling wedge forms after a downtrend, it's usually a bullish reversal pattern. What do we mean? Meaning if we are seeing a wedge falling like this, we are expecting a break here, then we start to look for buying opportunities. That is what we mean by a bullish reversal pattern. So a falling wedge, basically you will see that the market was coming from here, okay? Then eventually it starts to consolidate, creating a wedge. So if we happen to see that the market breaks above there, then we start to look for buying opportunity, expecting the market to continue going up, setting our stop loss below there. That is a wedge pattern. And then this is an example of a wedge pattern in action. Then we have a rectangle pattern. A rectangle pattern usually occurs when the market is consolidating. By consolidating, we mean the market, it's not going up, it's not going high, it's just in a range. Let's say it was coming from here, then eventually it creates a support, and then it goes up and creates a resistance. It comes up to the same support, creating a double bottom, and then it pushes up again, creating a double top. It pushes down, creating a triple bottom. Then it pushes, creating a triple top. So this kind of market, it's known as a range market or a consolidating market. As a trader, you want to swing in this kind of behavior, whereby you want to buy here, take your profit there, you want to sell there, expecting it to go down, then you take your profit here. So a rectangle is a chart pattern. It's a chart pattern formed when the price is bounded by parallel supports and resistance level. So a rectangle reveals a period of consolidation, okay, or an indecision between buyers and sellers as they take turns throwing punches, but neither has dominated. Okay, the price will test the support resistance level several times before eventually breaking out. From there, the price could trend in the direction of the breakout, whether it's to the upside or to the downside. What we are saying is wherever this price will break out, that is where we are going to choose. If it breaks on top, we look for buying opportunities. If it breaks below, we look for selling opportunities. That is what we are basically saying right there. Okay. Let me clear this. So this is just an example of a rectangle whereby we had a pattern here. It was consolidating. Then if it breaks on top, you look for buying opportunities. In this case, if it breaks below, you have to look for selling opportunities. Very easy and straightforward. This is what most people use because they are easy. The people don't like what we did yesterday. For example, the FOMC, the meetings, the speeches by the Federal Reserve, because it looks complex to them, but that is what definitely moves the market. You don't want to miss out on that. Then we have, this is a rectangle pattern in action. That is just an example. And then we have what are known as peanut pattern. Peanut pattern, these are just triangles. They are more tight, like they get to emerge or they get to converge faster than the other patterns. But basically, if it breaks above, we buy. If it breaks below, we sell. In this case, this one can break any side. Even this one, it can break at any side. What matters is where it breaks. That is where we choose to go. Then we have the triangle chart pattern formation. Just like I was explaining, wherever it breaks, you look for your buying or selling opportunity right there. This is a peanut pattern in action. We had a pattern consolidating, market consolidating, then it breaks above, then you buy. Simple as that. So for you as a trader, or for you that are in this class, you don't have to wait for me or for anyone to give you signal. You just have to go on the market, look at the daily time frame, 4-hour time frame, 1-hour time frame, look for this pattern, enter, trade. Those are the signals. People pay for this. Just imagine, people pay for this just for us to look for this pattern. So we tell them buy now, sell now. Even you can be, if you be very good at identifying this thing, you can make a lot of money. You just have to practice. Then you can start giving signals. People can pay. You can make an extra income by charging for signals, for example. So long they are good, they are quality, you are not scamming people, it's good. So you can make an extra income, even like a 5K, a 10K a month. It's nice. Okay. This is just an example. And then what else do we have? We have categories. Let us group these chart patterns into 3 main categories. Basically, they are reversal patterns, continuation chart patterns, and bilateral chart patterns. Bilateral means they are both. So a reversal pattern, a double top, it's a reversal, head and shoulder is a reversal, and then we have bullish rising wedge is a reversal. By reversal, I mean the market was going up and then it creates a pattern. After that pattern, it reverses and starts to trend down. That is a reversal. This is a reversal, inverted head and shoulder is a reversal, all these are reversal. And then these are continuation patterns whereby the market was going up. For example, the market was trending up. It takes a break. And then after taking a break, it breaks above, it continues to go up. This is a continuation pattern. This is also a continuation pattern. The market was going up. Then it consolidates, taking a break. Consolidation meaning just ranging. And then it breaks on top, continuing the trend, the initial direction. Then this is a continuation pattern as well. This is a continuation. It continues. It was going down, takes a break, and then it continues. This is a continuation. This as well. It was going down, takes a break, then it continues. So those reversal patterns, and then we have bilateral chart patterns. These ones, whereby they are neutral. The market can either come from whichever direction, but these ones, if it forms a triangle that is kind of, it's not trending, it's not just in a range. If it breaks on top, you can buy. If it breaks below, you can sell. That are bilateral. That ascending triangle is also bilateral. Wherever it breaks, you go with the flow. This one, you go with the flow. The thing with the market is don't make it hard for yourself to choose a direction like, no, me, I'm going to buy, I'm going to buy. No, wait for the market to tell you what to do. Wait for the market to break. You just go with the flow. If you have in mind that you are waiting for a sell, or maybe what is known as confirmation bias, whereby for you in your mind it's just a sell. No matter how much it buys, you don't want to accept, then you're gonna have a serious problem with the market. Go with the flow. Whatever the market does, do as it says. Basically, then we have what is called trading breakouts and fake outs. What are breakouts? We are done with the patterns. Can we move to breakouts? Or do you have questions before we proceed? If you have a question, please type in the chat room, or you can unmute your mic and come through. Let me know if we are fine. Please comment in the chat room or come through. Am I alone here in this meeting? Maybe people just logged in and they disappeared.
We are here.
No, we are here.
We are here, Master Stone.
Oh, okay, good. Should we proceed?
Yeah, we can proceed, man.
Okay. Okay, good. Now, we are done with chart patterns. We move to what is known as breakouts, okay? What is a breakout? This, we look at the definition. A breakout occurs when the price breaks out. You get it? There was a level and then it passed that level. Maybe there was a support and then it just passed, it melts down, or there was a resistance, then it goes above the resistance of some kind of consolidation or trading ranges. A breakout can also occur when a specific price level is breached, such as a support or a resistance level or a pivot point or a Fibonacci level. With breakout trades, the goal is to enter the market when the price makes a breakout and then continue to ride the trade until volatility dies down. Okay, you want to jump on the trade immediately when the breakout occurs, then you ride it until it loses energy. When it loses energy, you jump out, you take your profit, you run and withdraw. Now, we have a continuation breakout. Basically, let's assume you happen to see a rectangle. The market was consolidating. When it breaks out, what you do, you jump. If it breaks at the bottom, you sell. After you sell, you ride until you see that the market is getting exhausted, then you jump out, you run. The same here, it was consolidating. When it breaks above, you buy, then you ride the market, then you jump out, you run. So sometime when there's an extensive move in one direction, the market will often take a break. This occurs when buyers and sellers pause to see what they should do next. As a result, you will see a period of range-bound movement called consolidation. Breakouts are very important because they indicate a change in supply and demand of currency pair you are trading. This change in sentiment can cause extensive move that can provide excellent opportunity for you to catch a big move. Okay. This is more like what we covered already. Then we have what is called fake breakout. Fake breakout, sometimes you feel like, okay, if I'm to wait until I see that there's a rectangle here, there's a rectangle forming right here. But now it's like, okay, if the market was coming from here, I can predict like, okay, maybe I'm expecting it to continue, meaning I will expect a continuation. What will happen is, what if I sell here and then I set my stop loss above where these two did not reach? Here, this one did not reach here, this one did not reach there. I'll put it here. And then I'll have to enter here. And then my take profit will be here. Then I'll just put my stop loss here. I'm only going to risk a $10. Then I'm going to make $100 by the time it's going to reach here. Now what will happen is the market will just go up, take you out, you lose a $10, you blow your account, maybe that was the only money that you had, then the market continues in the direction. So this is known as a fake out, and the market does that a lot of time. We feel like someone is watching you, you feel like the broker is against you, you get to be so demotivated, you'll be down and all that. So we're going to talk about that, stop loss hunts and liquidity, and all those things, liquidity pool and what. Basically, a good way to enter on a breakout is to wait until the price retraces back in the original breakout level, and then wait to see if it bounced back to create a new high or low, depending on which direction you are trading. Another way to combat fake out is by not taking the first breakout you see. So basically, sometimes you don't want to take the short immediately when it happens. You want to wait a bit and see. But it's really hard, you know. What do I mean? You know, I feel the market is underrated. We feel, after knowing supports and resistance, chart patterns, we feel we can easily predict the market. But the market it's very smart. In other words, I always say that, you know, the market is moved by people, okay, traders and market participants. You want to be smart to make money from people that are extremely smart, that also want to make money from you. Everyone wants the other one to lose, and you want to win. So that is the whole, it's a highly competitive market. So we have to really, really be careful not to be too overconfident, not to always see like, oh, here is a chart pattern, let me put in all my money. You'll be making a mistake. The market can do anything at any time. So look for confirmation with candlestick patterns after a breakout. For example, a strong bearish candle closing below a resistance level can perform the move. Let's say this was the market, and then eventually we get a breakout with a strong candle, then we can now enter the market. But that is what the message, that is just the message that is there. Then that is it for tonight. That is what I had for you, chart patterns. Thank you for staying until the end. I hope you found the information valuable and insightful. Remember to review what we have discussed and feel free to reach out if you have any questions. I look forward to seeing you all in our next class. Have a good night ahead. Unless there are questions, our next class, since today is Thursday, our classes usually ends on Thursday. Our next class will be Monday, 8 o'clock. For that, I'll end the recording, then I'll take in questions or comments. If you have a question, you can unmute. If it's clear, you can also write it's clear, then yeah. Any question or comment? Oh, very clear. It's clear from my side. I think it's clear so far. Okay, good. If it's clear, then thank you so much, guys, for coming through. See you on Monday, same time. Have a blessed weekend ahead. Take care.
Good night.
Night.
Thank you. Good night.
Thank you. Good night.
Good night to Danko.